providing the magical money mystery tour tonight. And I'm giving you the life lessons I've learned the hard way through decades of investing. Right now, I want to tell you how I got started in individual stock picking, something you know I love and still believe in, even after multiple periods of pain, chaos, and chicanery. Presumably you believe too, or else you wouldn't be watching. If you're picking stocks, playing with real money, not just with a ledger or with a game of stocks and bonds, you need to open an account. When I got started in 1979, there was no such thing as an online account. I had my money with Fidelity, courtesy of my Magellan Fund account, so I chose to put my individual stock account there too. When I first began, I didn't know where to look for ideas, so I turned to a magazine I liked, Forbes. Now, people at Forbes, please don't take this personally, but I read a nifty article about American agronomics, a terrific orange grower in Florida. It seemed so compelling that I bought 10 shares of it for $9. A week later, frost hit, wiped out the crop, and my investment was more than cut in half. Like the plot of Trading Places, an all-time great Eddie Murphy movie, if you've ever seen it. Well, what can I say? Pretty similar. I was devastated, but not defeated. I sold it out, took the capital, and bought 7 shares of Bobby Brooks, a clothing outfit I'd heard of, which, again, Forbes said could be a terrific buy. Almost immediately, the company reported a bad quarter, and my money halved again. Fortunately, I had a decent job at a magazine called American Lawyer, which had just started. I was making 20 G's and living in a less-than-swank studio on 44th Street between 1st and 2nd, near the United Nations. The cheap $40 a month rent allowed me to replenish my stock coffers pretty quickly. I was on the road quite a bit back then, and after a particularly hard night on the town researching a story in Kentucky, I fell in love with the breakfast at Bob Evans Farms. Finding out that it was publicly traded when I went back, I visited that huge, fabulous Midtown Manhattan, New York public library, the ones with the big lines in front of it, and devoured everything I could find about Bob Evans. They had magazines with articles, microfiche of 4-month-old financials, investment publications, with write-ups that allowed me to compare Bob Evans with other companies in the industry, which is what you have to do. I knew I had a good one, so I bought 20 shares. Stock went up immediately with a good quarter, a stock split, and I figured out the first good component of investing. Know what you own. What did I know about growing oranges with American agronomics? I mean, who knew? Did I know anything about women's fashion? I mean, certainly not me. But a good plate of scrambled eggs and sausage after a hard night on the town, well, that's served in an attractive setting, good service, nice enough growth, a big plan to expand in the Midwest. That was for me. Next up, SPS Technologies. That's the old Standard Press steel, an outfit from my old hometown that made fasteners, screws for airplanes, something that Hal Met now dominates. Why SPS? Because a buddy of mine from high school catching up with me told me that they were hiring like mad if I was looking for a job, paying good money. Well, I already had a job, but back to the library for more research. Solid company, no debt, but nothing in print about its hiring push. Wow, ripe for a trade. SPS doubled not long after, and I caught the bug for good. 23 years later, it would be acquired by Precision Castparts, the preeminent supplier to aircraft builders around the globe, before PCP went on to sell itself to Berkshire Hathaway in 2016. Good bloodlines. So now I'm figuring it out. The best investment ideas come from what you know, melded with information gleaned from public sources, even if they're as late and as hard to access as taking a surreptitious trip to the New York Public Library when I was supposed to be working. I didn't like the random way I was making money. A friend from home's lucky call about jobs available at SPS Technologies, a hearty breakfast at Bob Evans Farms. I mean, I figured that'd be a more rigorous approach, right? And then it hit me. Look around at work, stupid. At the time, I was covering mergers and acquisitions, looking at the lawyers who do the deals, profiling some, following the deals they were on. It seemed like every other deal was in the oil patch. One after another, smaller to mid-sized oil companies were being acquired, and all I was doing was standing around writing about them. So I went back to the library, took out some editions of a thing called Value Line, stock research magazine, and checked out the pages devoted to oil companies. Then I cross-referenced them with other research to find out which ones could be acquired without problems, either because they were publicly traded without a family owning them, or because they seemed to fit the size, the parameters of so many other deals. So I settled on this thing called Natomas, an oil company with a real gusher in Indonesia. Oh, I didn't have long to wait. Kerr McGee struck. Bought them. Almost doubled my money. Another lesson learned. You want to play takeovers, buy companies that would do well on their own. Natomas was, but it was undermanaged, which was the consensus I found by reading the articles about the oil enterprise. That meant another oil company with bigger scale could do more with Natomas, which was cheaper than it should be if it simply got rid of the existing management. As much as I hit some winners, though, I was distraught that I'd given up the ghost in those first few trades. At the time, I'd been hanging around the track on weekends, mostly Aqueduct, nearby. And I learned how to handicap by reading the books of Andy Beyer, the legendary horse racing writer. He is something, okay? Beyer's Picking Winners is among the best investing books ever written, even as it's betting on the ponies. It teaches discipline, how to identify the best thoroughbreds to bet on, how to find the best long shots, going to the out-of-the-way tracks where information was less well known, not betting willy-nilly on every horse in each race. Find the ones where the payoff was more sure and bet big. Cut your losses if you're having a bad run. Every one of these lessons could be applied to the stock market, right? I mean, you can take a huge swing when you know what you're doing, particularly when others don't on a less well-known stock. out of the way track. Don't just gamble on stocks for the excitement of it. That is foolish. Most important, be disciplined. Don't let your losses pile up. After 5 years of professional journalism, I decided to hang it up and go back to law school. The good news, I'd saved enough money to pay for my first year, all in the stock market, as I never would have had enough money to cover the cost of it if I just kept my money in a savings account. So here's the bottom line. You want to get started, go small. Invest in what you know. Research intensely. Just research. Back then, I got old data from public library. Now, it's as simple as a keystroke, and the information is free, including up-to-the-minute financials, analyst presentations, brokerage research, and, of course, the conference calls that I tell you are musts if you want to actually know what you're doing. Simple? No. Lucrative? You bet it is. Let's go to Michael in California, please. Michael.
Yes, Jim, first of all, thanks for taking my call.
Of course.
I'll try and make this as quick as possible, as I know we got a lot of people to help here. This has to concern my two children. I inherited recently quite a deal of money, not $1 million, but a substantial amount. And I'm looking at a 20 to 30-year time frame here. I've been investing for them since the day they were born. They're doing all right, but I want them to leave them some good money. I'm thinking on the lines of Berkshire B, and now this is putting all this money. Berkshire B and ETF, a Vanguard ETF, or some of that, somewhere along those lines. What's your opinion?
Okay, I think that S&P 500 fund and the total return funds are both really good for that kind of situation. Vanguard's total return. The one thing I would caution is, as much as I like Warren Buffett, I just think that you have to have a kind of a basket if you do one stock. But if you do the ones that I just mentioned, you don't need a basket, and you don't have to keep track of them every minute. By the way, if they're young enough, maybe you give them something that they actually want to spend some time learning about, and that could be good, too, to keep them invested and interested in their money. But thank you for those kind questions. And let's go to Loyal in Arkansas. Loyal.
Yes, sir. How you doing, Mr. Cramer?
I'm doing well, Loyal. How about you?
I'm doing all right. I just wanted to know, getting back into the market with 11K, what's the best way to have a long-term goal, but get a short-term return within a year or two on your investment?
Well, it's too risky, frankly. I at one time or another, I think in my earlier years, I would have suggested call options and then also some longer-term stocks and mutual funds. But these days, I'm just against the short-term stuff. I can't deliver, and I don't want to encourage trading. But thank you so much. I wish I could do better for you, but it's just not my thing. Trading things, not my thing. Anyway, if you want to get started in stocks, go small. Invest in what you know and research intensely. The process may not be simple, but boy, it can be lucrative. All right, much more Mad Money ahead, including an inside look at what I learned from my time at Goldman Sachs. Plus, I'm taking your investing questions with my Investing Club colleague, Jeff Marks. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.